All right, we're diving straight into some pretty wild financial predictions today. Our sources are pointing to a huge market event, and here's the thing, this isn't just a guess about a downturn. It's about a historical pattern, one that some analysts are saying is playing out right now, in real time. So, yeah, let's get into it.
And you really have to start right here. Think about it, the one investor who made billions calling the 2008 collapse, he just shut down his hedge fund. Now, when the guy who saw the last crisis coming decides to just pack it all in, right when the market is hitting all-time highs, well, that's not just another headline. That's a massive, blinking red light.
So, what does he see that the rest of us don't? Well, according to the source material, the central idea is this. Huge economic collapses, they aren't random. They're not chaotic acts of nature. No, they're more like a script. They follow a very predictable, almost mathematical pattern that has just repeated over and over again throughout history. And this is really the heart of the entire argument, so lean in for this one. The sources aren't just presenting a theory of what could happen, they're claiming this is a documented historical fact. The exact same six-stage pattern has played out before every single major collapse from ancient Rome all the way to Weimar Germany, an identical script every time.
Okay, so this is where it gets really serious. According to this framework, we are currently in stage 3. And why is that so important? Well, because in every single historical example, once a civilization hit stage 3, the final collapse, the reset, was only 24 to 36 months away. If that's true, it means the clock is officially ticking.
So what is this blueprint? You're probably wondering, what are these 6 stages that supposedly predict the end of an economic cycle? Let's lay it all out.
Okay, so here's the sequence. It kicks off with stage 1, easy credit. And, we've had years and years of that, right? Rock bottom interest rates. That naturally flows into stage 2, debt saturation. That's the point where you just can't stimulate the economy by piling on more debt. And that, according to the analysis, brings us to right now, stage 3. Production stagnation. They also call it the interest trap. It's basically a mathematical point of no return. It's where pretty much all your new economic growth is just going to pay off the interest on all the old debt you already have. You're just running to stand still.
And this slide, wow, it really shows you just how spooky the parallels are to the past. I mean, look at the lead up to the 1929 crash versus today. It's almost a mirror image. You've got low interest rates, a huge explosion in margin debt, basically borrowing to gamble on stocks, and this widespread belief that this time is different because of some revolutionary new tech. Back then it was the radio and automobile. Today it's AI. The story changes, but the underlying math, the analysts say it's exactly the same.
This leads us to a really fascinating idea from the source material, this concept of Sentinel investors. Think of them as the true masters of the game, the legends. And it turns out, their actions have historically been one of the most reliable warning signs you could ever ask for.
I mean, just look at this pattern. It's undeniable. Right before a massive crash, one of these sentinels just leaves. In 29, Jesse Livermore shorts the market. In 2000, Julian Robertson closes his huge fund literally 1 month before the dot-com bomb goes off. In 2008, who else but Michael Burry closes up shop right after his big short bet pays off. And now, here we are, and he's done it again.
And this is the big one, the main event. Burry's firm, Scion Asset Management, just terminated its SEC registration. What does that mean? It means he's going dark. No more public filings. He's pulling the curtains, disappearing from public view at the peak of the market, just like he did back in 2008. They say if you're at a poker game and you can't spot the sucker, you're the sucker. Well, what does it mean when the best player at the table just gets up and quietly leaves the room?
And here's the reason. Straight from the man himself. He's basically saying that market prices have gone completely insane. They're totally disconnected from any real underlying value. The math just doesn't add up anymore. And for a guy like Burry, who lives and breathes by the numbers, that means the game isn't just risky, it's irrational. And like in the movie War Games, the only winning move is not to play. Okay, so if the whole market is one giant bubble, you have to ask, where's the pin? What's the thing that's going to pop it? The source material points to a few specific ticking bombs. Let's look at 3 of the biggest ones.
Before he vanished, Burry's last public filing showed this one, staggering number, $912 million. That's how big his bet against the AI company Palantir was. We're not talking about a small hedge here. This was a nearly billion-dollar declaration that the entire AI hype train is about to go off the rails.
All right, next up is a potential weak spot that most people aren't even looking at, physical silver.
The argument here is that demand for real physical silver, for things like solar panels and EVs, is just exploding. It's being used up way faster than it's being mined. So what happens when the warehouses start to run empty? You could get a situation where the price of paper silver on a computer screen totally breaks away from what it costs to get your hands on an actual physical bar. And that kind of breakdown can shatter confidence in the whole system fast.
And then there's this one. It's like a ticking time bomb. It all centers on MicroStrategy, the company that holds more Bitcoin than anyone else. The problem is they hold so much Bitcoin, they might get kicked out of the NASDAQ 100 index for not being diversified enough. This isn't speculation, it's just a boring bureaucratic rule. But if that trigger gets pulled, watch the dominoes fall. 1. All the index funds have to sell the stock by law. 2. The stock price tanks. 3. That crash could trigger their lenders to call in their debts. And 4. The final domino, they could be forced to sell their massive Bitcoin stash, which could just obliterate the entire crypto market. It's a wild example of how one tiny rule change could start a financial avalanche.
Okay, now we get to what might be the most important part of this whole analysis, the most chilling argument. And that's the idea that the next crash, if and when it comes, it's not going to be a repeat of 1929 or 2008. This time is fundamentally different. And the reason why is that it might be a lot harder, maybe even impossible, to escape.
The sources call this concept digital cages, and it makes a lot of sense when you think about it. The whole financial system has been re-engineered since 2008, right? But all these new features, ATM limits, trading halts, redemption gates, processing delays, they're not there to protect you. They're there to protect the system from you. They're designed to stop you from getting your money out when things go bad. And this comparison really drives the point home. Back in 1929, if you got nervous, you could literally walk into a bank and demand your cash. You could hold your stock certificates in your hand. The system was physical. It was direct. Fast forward to today, and your savings are basically in a digital prison. Trying to get money out of your 401k? You're hit with huge penalties, and you'll wait a week or more. The bank? You're limited by how much you can take from an ATM. Your brokerage? They can just halt trading or block you from selling. It's like every single exit door now has a brand new, high-tech lock on it.
And that's the key takeaway right there. The lesson the powers that be learned from the Great Depression wasn't how to stop crashes from happening, it was how to control the stampede for the exits. The old system failed because too many people could get their money out at once. The new system is designed specifically to make sure that can never happen again. When the panic starts, your money is designed to stay put.
So what's the brutal bottom-line consequence of all this? According to these sources, it means that your trapped savings, they become the exit liquidity. What does that mean? It means your money is the cushion that absorbs all the losses. It's the money that allows the big institutional players to sell their assets and get out, while you're stuck on hold or staring at a transaction pending screen.
Which leaves us with one heck of a final question. The sources we've gone through today claim these historical patterns are basically unbreakable, like a law of nature. So, if they're right, if we really are in stage 3, are we just watching a black and white rerun of 1929? Or, with all these new digital cages trapping everyone's money, are we about to watch the world premiere of something far, far worse? Something to think about for sure.